changes to FRS 102, focusing specifically on the lease accounting and revenue recognition amendments. As many of you will be aware, these changes will apply for accounting periods beginning on or after 1st of January 2026, and therefore are likely to apply to 31 December 26 year ends first of all. And some of these changes are going to have a significant impact on a wide range of businesses. The aim of today's webinar isn't to give you all of the detail, but it's to give you a clear and practical overview of what is changing, perhaps where the complexities lie, and also what you should be starting to think about now in preparation for those changes. I'm delighted to be joined today by two of our specialists who've been closely involved in analysing these changes and advising clients already. This is Nick and Vinay. Between them, they are leading much of our work in this area, including developing guidance for our own teams and our clients as well. This session is being recorded, although you're muted, so that shouldn't make any difference to you, but it does mean that the seminar will be available afterwards. There's also going to be time for Q&A at the end of this seminar, and you'll see at the top of your screens, depending on how your Teams is formatted, the Q&A button. You can use that button to submit a question, and we'll review those during and at the end of the webinar when we will answer a summary of the questions. So again, thank you for joining us. I'm now going to hand over to Nick first to take us through lease accounting, and then we'll hand directly on to Vinay to go through some revenue accounting. Nick, over to you.
Thank you, Steve. Good morning, everyone. I'm just going to take you through the big changes that are coming through with the lease accounting. So this is probably an area that's going to impact the majority of businesses. So I'm just going to talk you through it and the things to look out for and the things you need to start thinking about now in preparation for that change. So we're going to look at how it affects your business, looking at how you currently treat things against what the new standard is going to show you, how the numbers will move, the judgments that you're going to have to make, and that's perhaps going to be the most complicated part of it, and what it actually means for your business kind of practically, and how it might impact other things other than the actual numbers on the face of the P&L and balance sheet. So as Steve's already mentioned, this comes in from any accounting period starting from the 1st of January. So basically what it means is today under the former standard, you would recognise things like property leases, car leases through your P&L as you incur them, as you're charged by your landlord or your lease provider. Going forward, there's a distinct change in tone. So you're going to have to put these on your balance sheet and recognise something called a right of use asset and an equal lease liability. And I'll talk you through that in the coming slides. The cash you pay on those leases doesn't change, but it might impact things like your EBITDA. So who does it actually impact? So this impacts small and medium-sized entities and large, but if you're preparing your accounts under FRS 102 and FRS 102 Section 1A for small companies, you will need to account for these changes on your balance sheet. If you're a micro entity, you're not really impacted, so you still prepare your accounts as you currently do. So rent goes through the P&L as normal. For FRS 101 and IFRS, you should already be used to this, so there's no real change for you. And with groups, you're going to have to start thinking about it if you've got a group that prepares under 102. So again, this is just a brief summary of before and after. So as I said, currently, you have a rent invoice, you put it through your operating expense as the rent is charged to you. it reduces your EBITDA because it's within your operating costs, and it has no impact on your balance sheet because you're not recognizing it on your balance sheet. So the distinct change is that everything's going to be sitting on the balance sheet going forward. So you'll have a right of use asset and a lease liability recognized on that first period of transition. And then as you go on each year thereafter, you're going to release, you're going to depreciate that asset as you would with other assets, and you're going to put through a notional interest for that lease liability that you've recognized. What that does mean is, because depreciation and interest are excluded from EBITDA, it means your EBITDA is higher, because you don't have the rent charge going through there. And obviously it's going to impact things like your gearing ratios as you've got more liabilities sitting on your balance sheet. As I've already alluded to, you recognise an asset for the right of use asset and an equal liability for the lease liability. Essentially, you have to calculate that based on the present value of future payments. And I'll talk you through some kind of simple examples just to give you a kind of flavour of what it might look like. With this adjustment, it's a prospective application, so it means that you don't have to restate previous years. So if you're in the middle of a lease, you don't have to go back and change how you've recognized it in the past. It's a transition adjustment that you recognize at the start of the accounting period that it kicks in from. So I'm just going to talk you through some kind of simple examples just so you can see what it looks like in kind of practice. These are very simple. Obviously, different businesses are going to have different complexities in their individual leases, but this is just a starter just to give you the concept. So in this scenario, it's a simple office rent, which is 100k a year over 5 years, and it's payable quarterly in advance. And assuming a borrowing rate of 6% for that business. So currently you would recognise that 100k through your P&L as rent, nothing sitting on the balance sheet. Going forward, you've got to recognise this right of use asset at 345k with a lease liability equal to that of 345k. And again, this is calculated by applying the borrowing rate over that 5-year period. And the next slides will kind of show you how that's calculated. So if we flip to the next one. Yeah, so here is what it will look like in kind of practice. What you'll notice here is under the old method, you got 100k per year. Under the new method, what it does, it front loads the interest costs. So you'll see in this scenario here, we've got a slightly higher P&L charge. So you've got a 10k higher P&L charge in the early years, and obviously that reverses in the latter years. But overall, you're still showing 500k over that 5-year period. It's just how it's allocated between the two methodologies that's slightly different. And this is what it will look like on your balance sheet. So at the first point, you recognize it, you recognize both assets, and then equally over those 5 years, you depreciate it until it depreciates down to 0 by year 5. And equally on the liability, you have a liability, you put through the interest based on that liability and deduct the cash you would have normally paid on your lease rentals. So as you see, they both neatly come down to a 0 liability, and then invariably what's going to happen is you're either going to have a new lease and then you start this whole process again. But as I said earlier, in reality, on transition, businesses are going to have leases that are already in effect, and you would have been recognising rent through your P&L previously. So in these scenarios, you've got to calculate for the transition adjustment, the amount of the present value of the future payments that are left at that point. So if we use the same terms as the previous example, but imagine the lease started a year ago. So your lease is the 1st of January 2025. So by the by the time you get to the 1st of January 26, you're a year into your lease, and essentially you've got 4 years left. You have to do that calculation based on the time left on your lease, and then it unwinds down the same way. Also, what to consider, and this is commonplace within a lot of leases, particularly property leases, are things like dilapidations provisions. So you've got to carefully look what's in your lease agreement, and that will stipulate what your dilapidation requirements are. So this is where you might need some kind of assistance either from your landlord or a property advisor to establish what that liability could potentially be at the end of your lease. Property experts would normally be able to assist in that, but the principle's the same. Once you know what the expected dilapidation provision could be, you apply the same discounting rate as you established in your lease calculation, and you recognise a provision which you release over the remaining period of your lease. So this is really where there's going to be a bit of judgment to be made. So each and every lease has different terms and different conditions. So you're going to have to carefully obtain all your leases and look through them to establish the specific requirements for your business. So the first point mentions break clauses. So typically you might have, say, a 25-year property lease with a 5-year break. What you guys as business owners and business managers have got to establish is whether you're actually going to utilize that break clause. Say you might have a 5-year break. You've got to establish whether you think you're actually going to exercise that clause from the start. In some businesses, because the premises or the location are so implicit to the business, it's hard to ever realistically break. So you have to perform your calculations over the period you expect to utilize that lease for. As I previously mentioned, you've got the dilapidations provision, restoration provisions. So you've got to ensure you've calculated that from the start. So like I've mentioned, get those property teams looking at that for you, or a surveyor to give you an idea of what your future provision or your future cost is going to be. A lot of property leases particularly will have rent reviews. They're either going to be linked to RPI potentially, and you have to assess those at the time because RPI and CPI change based on the economy at the time. But then other rent reviews might have a set percentage, so you have to factor that into the cash flow of your calculation. You have things like rent lease incentives. So for instance, you might have a 6-month rent-free period at the start of a lease or at a lease renewal point. So you have to factor that in and reduce your overall liability based on that. And then another point to kind of just be aware of is things like service charges and lost non-lease items, just to make sure that they stay within your P&L and you're not kind of capitalizing those. And again, just pick out things like the upfront costs. So the discount rate is probably the area which is going to be the most subjective part for a lot of businesses. So this is essentially the discount rate you're going to apply to your future cash flows. So there's 3 permitted methods that the standard allows to be used. So the first one is the rate implicit to the lease. This is probably the one that's going to be used the least in practice, I imagine. A lot of the times you won't know the value of the property you're leasing or how much the landlord spent on it to get it up to the standard it is. You don't know what the landlord has assessed its residual value as in the future. So that one's going to be a really tricky one to obtain. With some assets, it's possible, but it's a bit more tricky one. I think in theory, a lot of business owners will be using the incremental borrowing rate and the obtainable borrowing rate. So these two are very similar. There's just a slight nuance between the two methods here. So the incremental borrowing rate is the rate you'd go to your bank and borrow at for a similar asset. So in the example of a property lease, you'd go to your bank and it would essentially be the mortgage rate they'd lend you that money at, because it's a secured borrowing, buying a property, and you'd have to establish the same length of time as the lease that you're intending to sign up to or have signed up to. The obtainable borrowing rate, I think, will be probably the one that's going to be the easiest to obtain. So if we use the examples I've mentioned previously, so this is essentially borrowing that £500,000 from the bank. This is the rate the bank would lend you that money for over that length of time. So there's a couple of exemptions where you don't have to put them through the balance sheet. So these are just to simplify things. So the first exemption you get is on short-term leases. So these are anything that's less than 12 months. So for instance, you might hire some machinery for some kind of seasonal work. Say over the summer, you might hire some machines over that 3-month period. You just pass that charge through the P&L. You don't need to worry about capitalizing them and then depreciating them. And then the other exemption is on low value assets. So the standard doesn't actually give us a definition or a limit to the low value, but the IFRS does, and that indicates a level of $5,000, which is roughly £4,000 in the UK. And so this is aimed at items such as where you have a mobile phone contract, for example, and you're paying for it over a 2-year period, for example. So you just it's to avoid you having to capitalize smaller items such as that. So what do you actually need to start pulling together now? So what you've got to do is find all your leases that you have in kind of play at the moment. The important thing is to check the terms of each of them. So as I've previously said, those will be the important things for you to understand those extension options, those break clauses, what the dilapidation provisions mean. And then you've got to take a view on some of those things. So like I mentioned, are you actually going to exercise that break clause? Are you going to take an extension? And that's going to be factored into the initial calculation. And then you've got to figure out what your discount rate you're going to use is. So you've got to maybe go and speak to a bank manager, or if you're part of a group, you might be borrowing within the group. So it's then going up to the parent and asking how much their borrowing rates are. And then it's just having those conversations. So it's having those conversations with your lenders. So for instance, you might have bank covenants on loans existing or on other types of borrowings. So the standard's going to mean that your ratios such as EBITDA are going to change, your gearing ratios are going to change. So you might want to get those covenant terms reassessed and changed for the new standards. The other thing you'll have to do is obviously brief board members and directors and investors of the changes, because it's going to mean a slightly different EBITDA ratio for them too.
Thank you, Nick. We were going to save questions to the end, but there were a couple of useful questions that have come in actually. So perhaps we'll just pop a couple of questions now, but that doesn't mean to say that you can't still put your lease questions in the Q&A, folks, because we will pick them up at the end. Nick, I don't think you mentioned anything about tax. At the moment, we normally get tax relief on the rent paid. What will the
Correct.
tax position be on the new items going through the P&L?
Okay, yes. So it's slightly different to how it is now. So with the new right of use asset, you'd be depreciating that. With kind of standard assets that are depreciated, those are normally added back for tax. So essentially you don't claim it. But with right of use assets, because you're not claiming the capital allowances up front, the right of use asset depreciation is actually allowable for tax. And as is the interest charge that's going to be flowing through the P&L each year. So what it actually will mean is, per my example shared earlier, you'll have actually a higher tax saving in the earlier years, and that just flips round as you get into the latter part of the lease, because essentially there's less cost going through, which means the profit is slightly higher in the latter years, and obviously the tax will be slightly higher thereon.
Thanks, Nick. And Nick, do you know anything about the small value asset rules and whether that specifically includes or excludes laptops? Somebody said they heard a rumor that laptops might be excluded from that. Don't know whether you know.
Yeah, I think it would. Again, it's looking at the terms of your agreement. For example, though, if you're buying like a big batch of laptops, that might not be perceived as being low value. So say an entity buys, I don't know, 20 laptops on a plan, I would capitalize that. I think it's aimed for if you're buying one or two laptops.
Okay. Thanks, Nick. Okay, let's move on to revenue recognition. Vinay, can you take us through the revenue changes, please?
Yeah, sure. So good morning, everyone. Those, if you go to the next slide. So as mentioned by Steve and Nick, these changes come into play for accounting periods starting on or after the 1st of January 2026, and they bring the UK accounting standards more in line with IFRS. So the new revenue recognition model aims to improve the comparability and transparency in financial reporting, provide a more consistent framework for recognizing revenue, and ensure that revenue recognition is more in line with the substance of the transaction. So just to summarize the old model, under the old model, revenue was recognized when it was probable that economic benefit would flow to the entity and that revenue could be measured reliably. And for long-term contracts, we looked at stage of completion or percentage completion methods, and it was deemed that this approach had led to multiple interpretations, particularly when dealing with complex contracts involving multiple elements. So the new model, we have the 5-step approach now. So step 1 is identifying the contract with the customer. Step 2, identifying the separate performance obligations. And a performance obligation is the promise to transfer distinct goods or services to a customer. Step 3, to determine the transaction price. So this is the amount of consideration receivable in exchange for the goods and services. And the complication can arise here where we have instances of variable consideration, or when consideration is payable over a number of years, which leads to time value of money complications, and also in some instances when there are non-cash consideration. Step 4 is to allocate the transaction price to the performance obligation. So where a contract includes multiple performance obligations, we need to now consider the standalone selling price of each one. And where this isn't available, the company is going to be required to estimate that standalone selling price. And this is an area which could require a lot more judgment and therefore also require additional disclosures in the accounts. And then step 5 is to recognize the revenue. So the model shifts the focus to transfer of control rather than transfer risk and reward. And the standard also provides detailed guidance on the treatment of modifications in contracts. So to move on to an example to hopefully take you through this one. So in this example, it's a construction company, and here the company entered into a £10 million contract to build a warehouse. And this is broken down to 9.5 million for the overall construction. It's an energy efficient upgrade, 300k, and a performance bonus for early completion of 200k, which gives you a total contract value of 10 million. And in our scenario, we're estimating the total costs to be 8 million for the business, and the construction would take 2 years to complete. So under the old model, entities could treat the whole arrangement as one contract and recognize revenue on a percentage completion basis. So, for example, assuming at the end of year one, £4 million of costs were incurred, 50% of the revenue could be recognized. And for the performance bonus, this wouldn't be recognized until it was highly certain, i.e. towards the end of the contract. So for the new model, companies are going to now have to assess the 5 steps. So identify the contract, we know the terms, identify the performance obligations. Now, under the new model, there are 2 distinct performance obligations, being the construction and then the energy efficient upgrades. Step 3 would be determine the transaction price. So we know the value of the construction and the energy efficient upgrades, but now under the new model, we can recognize part or all of the completion bonus. And the reason is the new standard allows for these bonuses to be recognized when it is probable rather than when it is certain. So in this scenario, the company has made an assessment that 70% of the time they meet their bonus, so therefore 70% of the bonus can be recognized. So the total transaction price for this contract is now deemed 9.94 million based on these elements. And then step 4 is now to allocate the revenue. So here the entity now needs to determine the standalone selling price for each obligation. So i.e. if the elements weren't bundled, what would they sell them for? Because there is an implication that when companies bundle, they're building in inherent discounts. So in here, in our scenario, it says the unbundled price was 200k more expensive. So using these percentages, so 94% of the contract is the construction element, and applying that percentage to the transaction price gives you the revenue to be allocated for each obligation. And then step 5 is to recognize the revenue. So going back to the old method, you can still determine the percentage completion in the same way, but this assessment now needs to be applied to each performance obligation, and then revenue is recognized accordingly. So in our scenario, we've said 50% of the construction is complete in year 1 and 20% of the energy efficient upgrades are complete in year 1. And to give a kind of direct comparison of the two then, and the impact it can have, in this scenario, more revenue has been recognized under the new model, as ultimately the bonus has been recognized sooner. But we can see that this can have quite a significant impact on the accounts. Transition approach. So unlike leases where the guidance has given you one, we actually have 2 approaches that can be taken for revenue. So the cumulative approach, this is the much simpler approach, and is actually in line with what Nick mentioned for leases. So entities will adjust for contracts outstanding at their transition date, so 1st of January 26 for December year ends, and any transition adjustment will be posted to reserves. But we also have the option of a full retrospective approach, and this allows businesses to restate their comparatives. So if you have a December 26 year end, it almost treats a transition date as if it was the 1st of Jan 2025, and this will give you a more comparable P&L. But ultimately, it's up to the business to assess which one is more appropriate for them, and it's worth communicating with key stakeholders at this stage to understand what their preference would be. So just to give you a summary of the types of revenue that would be most impacted. Bundled revenue arrangements, we've just seen an example of that. Revenue now needs to be split and allocated accordingly. Variable consideration, so for example, rebates, discounts, usage-based pricing models, you need to be estimating them from the onset. Upfront fees, so for example, setup charges, onboarding fees, they cannot automatically be recognized up front, and companies must assess whether they transfer a distinct service. Long-term contracts, so the focus is on transfer of control, as I mentioned, and contract modifications become a lot more complicated under the new model. Customer loyalty and incentives, reward points or renewal incentives, often now treated as a separate performance obligation. Warranties, so where the warranty could be purchased separately, this should also be considered as a separate performance obligation. So the previous example looked at bundled revenue and long-term contracts, but also just want to go through an example for upfront fees, rebates, and warranties, as these are common scenarios we've seen in our client base. So upfront fees example, the classic is a gym membership. So for example, there's a joining fee and the contract is 12 months. So you have £40 a month membership with a £160 joining fee. Under the old model, the gym might have recognised £160 immediately and then £40 a month thereafter. Whereas under the new model, the joining fees need to be assessed in detail. So does it provide a distinct service on its own, or is it really part of the overall membership? For example, can you have one without the other? So usually it doesn't transfer a separate good or service, and as such, the £160 now needs to be deferred. So overall, the same amount of revenue will be recognised year on year, in total, sorry, but if your year end is in the middle of the contract term, revenue is going to change quite significantly. So the example for a rebate, so again, quite a common scenario. So a company has a contract with a customer whereby if its sales exceed £1 million, the customer will get a 5% rebate. So the overall net income to be recognised is 950k. Under the old model, revenue will be recognised in full initially and the rebate adjusted later on. Whereas now the new model is asking businesses to make an assessment and an estimation from the onset, and revenue then recognised accordingly. And this change aims to ensure that revenue reflects the amount the company is expected to be entitled to. Profit is not overstated initially, and variable pricing is reflected earlier. And then an example for warranties. So in this example, a company sells equipment for £1,200 and it includes a 2-year warranty. And assuming now that the warranty could be sold separately for £300, under the old model, £1,200 could be recognised in full immediately. However, following the new model, we have to split those into 2 performance obligations. Therefore, £900 be recognised initially, and then the £300 warranty would be deferred over the warranty period. So again, the same amount of revenue to be recognised over the whole 2-year period, but will impact revenue recognised in each financial year.
Nick, I think you're going to take us through a summary of what both of these mean for our businesses.
Yep. So obviously there's quite substantial changes needed and a bit of thought for business owners of these changes. So what it might mean practically for business owners are, as I've previously mentioned, things like the bank covenants. So it's just having those conversations with your bank and looking at your bank covenants to make sure whether any of the 2 sides of the changes could impact those ratios and any kind of interest cover ratios. What it could do indirectly are things like bonus and incentive plans. So for instance, you might have bonuses that are based on an EBITDA level. Obviously that EBITDA level is going to change under the new regime, so you're going to have a higher EBITDA. So you might need to just go back and look at those schemes and get them reworded and reissued with staff's agreement. What you might do is have a like-for-like comparison for staff if that's not possible, just so they can see this is how it would have been if the changes hadn't happened. The other thing it does do is the distributable reserve. So in the early years, you're going to have slightly lower profits because you've got the higher interest, but that balances itself out as you get closer to the end of the lease. So that's just something to consider if you're kind of tighter on things like dividends, amounts left to declare dividends on. Also, the next one is for just internal reporting. It's something that you need to discuss internally with stakeholders in your business. So if, for instance, you are presenting at a board meeting, you just got to explain to your peers what the changes are. So just getting that kind of detail so you can explain what the changes actually mean. What you might also need to consider are things like your systems. So if you've only got very simple couple of leases, it's going to be a lot simpler to say if you've got a big fleet of vehicles. So a big fleet of vehicles might be 50 or 60 cars. So it's going to be a lot more time consuming to perform those calculations. So it's just something to consider up front now, because there are some packages out there that can help you manage it if you've got a significant number. And obviously the tax, we've touched upon it already. It has a slightly different timing on the tax because it alters the P&L split over that period. Yeah, so as I've mentioned previously, it's especially for your leases and even for your income, you've got to just get the backup information together now. So sit and look at your leases, sit and consider how you recognize your income, and then just model those numbers, see what it's going to look like. This is where you might need some support from your individual accounts teams in-house, but also us within the group. So just make sure you speak to either us internally and we can assist where possible. Also talking to your banks and your staff of the changes. So I've touched upon it a couple of times. If you've got covenants, it's worth just discussing it if those covenants could be breached by the changes. And I'm sure the banks will be doing some internal briefings themselves. Also for your staff and your dividends and your KPIs, as I've mentioned, it's just getting those things that you might not consider that it impacts your initial P&L but are a byproduct of the accounts. So it's just getting your ducks in a line basically, and then just deciding how you're going to track them. Yeah, like I've mentioned, in a lot of scenarios where you've just got a property lease, for example, it's going to be a lot simpler if you've got multiple leases. But the key is just to start thinking about it, because some scenarios are going to be simpler than others. And there'll always be questions that come out of the woodwork that you might not have considered.
Thank you, Nick. And talking of questions, we have some time for some more questions. I've got a couple here that I will put to Nick and Vinay. Do feel free to put some more questions in the Q&A though, everybody. We've got some time. Nick, this is a little bit of a technical one, actually. I don't know whether you know the answer to this. Salary sacrifice schemes, where a business provides those to an employee, those form a benefit in kind, which technically I think the asset belongs to the company, even though the employee pays for it. Do you know what would happen with those under a lease scheme? I probably know the answer myself, but I'll let you jump in.
As I understand it, is you still would recognise the right of use asset and liability, because like you say, it's the company that's got the lease, and then you would depreciate it as the calculations show. And for the employee, the salary sacrifice, it's just a deduction from wages, because they're getting the benefit of the use of that vehicle. there's some camps that say that it's not actually a to the benefit of the business, because it's actually the individual member, the individual employee who's salary sacrifice that's using the vehicle for private use also. So I think strictly speaking, you do have to recognise it though.
Okay, thanks, Nick. Another question on leases. They're all coming to you, Nick, I'm afraid. If you're a cash-rich company and you have no borrowings, what would you do about the discount rate that you would apply to a lease? Can you use your investment rate, or would you still have to go to the bank and get a sort of notional rate?
I think you can, because essentially you're foregoing, it's the money you would forego. I think it's probably safer also to obtain the equivalent borrowing rate, because it's invariably going to be maybe slightly higher, just dependent on the asset type and the length of time you're borrowing that cash for.
Okay, so you could make an argument for both, I think, is what you're saying.
Yeah, I think it's just about considering both scenarios and seeing kind of how close they are to one another.
Yeah, okay.
As a kind of
And there's another
reason.
question here. There's a couple of questions actually about cars. The question is about cars, but you could apply it to other assets. We mentioned laptops earlier, but this question is cars. Would you use, if you've got a single car or a fleet, how would you account for that? I think the question is probably looking at interest rate, because if you've got a single car, say it's 30,000, but if you've got a fleet of 10 of those, it's £300,000, you might get a different rate for those. So would you look at them singly, or would you have to look at a whole fleet?
You can, with a fleet, if they're similar vehicles, you can apply a single rate. There's a kind of simplification within the standard that allows you to apply a single discounting rate across them. But you've obviously got to assess the assets within that fleet, and because you might have, I don't know, like a HGV trucks on one side and very kind of small value vehicles on the other side. So it's just assessing it on that basis.
Thanks, Nick. I've got another one for you, I'm afraid. Don't relax too much, Vino. There might be one coming for you as well. Somebody's asked about the VAT reclaims, Nick. So particularly on a car lease.
Yeah, it's the same. The VAT doesn't change. So you're still going to be booking the invoice as you currently do. It's just how the P&L bookings are changed. So essentially what you might do is I'm going to use debits and credits here. You're gonna book an invoice as you would normally. So you're going to go debit. In the past, you would have gone debit, P&L, credit, balance sheet. But in this scenario, you're going to debit your lease liability to reduce that per that cost. And you'd restrict the VAT as you currently do. So with vehicles, you half the VAT basically to 10%, and the other 10% that's irrecoverable, that goes through as a cost to the P&L.
Thanks, Nick. Somebody's asked, somebody unfortunately missed the start of the presentation and has asked, will the lease changes form part of this 2026 financial statements for December year end? The answer to that is yes, they will, but there are transitional arrangements. Vinay, let's have a question for you then, please. Where we're providing a service, or perhaps a legal firm is providing a service, but there's no letter of engagement in place, would that have any impact on how the fees are recognised?
I think that would come back to what the performance obligation is. Have you delivered anything to the customer or to-be customer once it's done the engagement letter? And so once you define what your performance obligation is, then you would consider the revenue recognition. Ultimately, if they've given you some money in advance and you haven't performed anything yet, it would be deferred.
Yeah, thanks, Vinay. Nick, question for you. This is about the obtainable borrowing rate.
Yeah.
Would it be acceptable to perhaps use a central bank lending benchmark and professional judgment rather than going direct to a bank?
Yeah, I think there's from what I've read, there's some camps that say you can do that. It's just when it's, say, for instance, in an audit scenario, it's kind of having the backup to show your auditors the rates you've applied. So you might say, well, for typical SME businesses in this sector, the unsecured borrowing rate would be base rate plus 2%, for example, and that's your kind of reasonableness check. From an audit perspective, you might just want to drop your bank relationship an email to say, well, if we were going to borrow this sum of money on an unsecured basis, what would you lend us that money at? You can also just look at the published rates at various banks as a kind of benchmark too. That might give you some more kind of a simpler way to obtain that rate. The only kind of slight issue with that is if we're now on the 19th of May, if your transition started on the 1st of January, technically it's the rate that you would have applied at that date that you need to apply.
Yeah, thanks, Nick. I agree. There's a difference between the central bank rate and the amount that you can actually borrow locally, because the banks are taking a margin on the central bank rate, so it's going to be different.
Yeah.
I think that's all. There is one other question just come in. Would revenue recognition change if you were doing the work overseas? I don't think it would it, Vinay? I think the rules still apply.
Yeah, if it's being recognised in the UK entity that's following FRS 102, the same rules would apply.
Yeah. Okay. I think there are no more questions coming in. So thank you all for your questions. That's been very helpful to give some clarity. Nick and Vinay, thank you very much for presenting. Oh, I've just got a couple more questions. Go on then, as we've still got some time. Can we still use percentage of completion methods under the new revenue standard?
You can. You just need to make sure you separate the performance obligations. So in that example they shared for a construction company, they'd apply the percentage completion for the whole project, whereas we need to make sure we kind of debundle first and then apply it. Yeah,
I think as long as the percentage of completion method is an appropriate method, then that would be
agreed.
Okay to continue using it. Absolutely, yeah. And there's another question about laptops, but I think we've already answered that. But if you've got a bundle of laptops and it's still insignificant amount, you could presumably not capitalize. Yes, Nick?
Yeah, you just got to assess.
If a laptop's £400 each, for
Exactly.
example, and you've got 10 of them and it's £4,000, would you treat that as a insignificant lease?
I would argue perhaps you would. I think the issue with the standards is it doesn't set a bar for what's considered low value. So you just got to use a bit of judgment, as kind of businesses do with when they set their capitalizing like the minimum point that you would capitalize something to. So if you've got maybe 2 laptops at £1,000 each, I would say that's definitely low value, and you wouldn't through as a right of use asset. I think this is aimed at when you're buying like tens of laptops. If you're buying a bundle, then you wouldn't use that, because although individually the assets are less than the 4K, but when you bundle them up, they would be significantly more. But yeah, I think in your scenario, Steve, at 400, if you're buying 10 at 400, you can maybe argue that they're small value or low value.
Okay, thanks. All right. Thank you all very much. Thank you, Nick and Vinay, for a very helpful and insightful presentation. I hope everyone has found that informative, helpful and practical. But as you've seen today, the changes to FRS 102 are going to have an impact on businesses, and there will be nuances. You know, people will have different types of contracts. There are going to be some odd leases, and it's not always going to be clear what to do. So do make sure you think about all of those contracts, all of those leases, and try to get to the right answer. And our key message is not to leave this too late. We're in a transitional year. Most of us, it won't apply until 31 December 26 year ends, but you know, you should be reporting during the year if you're doing management accounts. Are you going to leave it until the end of the year to make a change? If there's going to be a big change in your revenue reporting, you probably want to be starting to think about that now. So don't leave it too late. We're around to help. If you need help, please do ask us. Please speak to your normal Shaw Gibbs contact. Finally, thank you very much for joining us today. We appreciate your attendance and your engagement, and thank you for all the questions, and I wish you a great day ahead. Thank you very much. Goodbye.